Hi students, we are looking at part 2 of the video series on the bank reconciliation statement. Remember that this topic falls under office administration for CSEC examinations, and it's covered in section 9, which is accounts and financial services in the office administration syllabus. So let's just recap. And firstly, we recall that a bank reconciliation statement adjusts the balance shown in the bank to the current balance by entering transactions which have taken place since the last item on the statement. And in part 1, we looked at the introduction to the bank reconciliation statement. Now we are going to examine the procedures for preparing the bank reconciliation statement. So every 1 to 3 months, banks usually send hard copies or issue soft copies, for example, via email reminders of the customer's bank statement. This statement shows the amount of each deposit made during the period, the amount of each check cashed, the current balance in the account, service charges, and any other transactions related to the customer's account. So with this statement, the depositor or the account holder receives cancelled checks that the bank has not honored for that person's account, or checks that were returned, or checks that were not cashed. It is the depositor's responsibility to reconcile the balance in the checkbook, cash book, or other cash record with that given on the bank statement. As we indicated in part 1, if a difference exists that cannot be accounted for, then the depositor, who is the account holder, should call this fact to the bank's attention immediately. So let's look at the steps that should be followed when we are reconciling the statement, the bank statement with the cash book balance. So the first thing is we check each entry in the cash book against the entries on the bank statement so that those which do not appear on both can easily be seen. And one trick that I teach my students is to tick off the entries that appear in both the cash book and the bank statement and circle those entries that are different. So circle the entries that appear in the cash book only, circle the entries that appear in the bank statement only, and tick off those entries that are similar to both documents. Now, in doing so, we have to understand what these entries represent. And if we look at the cash book, on the debit side, or the debit entries would represent receipts, while on the bank statement, debit entries would represent withdrawals. Correspondingly, credit entries in the cash book represent payments, while credit entries on the bank statement represent deposits. And it's a reminder here to note that this fulfills the laws of double entry, where for each credit there's a corresponding debit, and for each debit there's a corresponding credit in the accounts. Outstanding or unpresented checks are those checks which have not yet been presented for payment or have not yet been cleared by the bank. Outstanding or unrecorded deposits represent those deposits which have not yet been entered into the account or not yet cleared by the bank. Standing orders, which we would know from previously doing the accounts and financial services when we looked at banking services, are authorized payments by the account holder of a particular sum on a regular basis, which he or she authorizes the bank to make on his or her behalf. Credit transfers are those transfers from one account to another which are authorized by the account holder. Interest paid or interest received are those interest on the account which the account holder receives from the bank. Bank charges are service charges which the bank would charge the account holder in order to keep his or her account active. So here are some entries that you are going to see in the cash book as well as the bank statement. So let's look at the formula for preparing the bank reconciliation statement. If you recall, in part 1, we said that you can either start with the balance as per cash book or the balance as per bank statement. If we start with the balance as per cash book, we have to add all the outstanding or unpresented checks from the bank balance. We are reminded that these are checks which you, the account holder, have written or issued, but these checks have not yet been presented for cashing or for payment by the payee, or the the funds have not yet left the bank, or the check is being held for a certain amount of time. Any other items that the bank was unaware of but are known to you that would reduce the balance of the cash book have to be added to the balance as per cash book. You are to subtract any deposits not yet recorded by the bank. These are referred to as unrecorded deposits. You are also to subtract any other amounts known to you but unknown to the bank, and bank charges that you did not know about. So you are subtracting anything that would increase the balance as per cash book. When you add the outstanding or unpresented checks and subtract the unrecorded deposits, you are supposed to get the balance as per bank statement, thereby reconciling the cash book balance with the bank statement balance. So that's looking at it from starting with the cash book balance. Let's look at starting with the bank statement balance. If we start with the balance as per bank statement, we do the inverse. So we subtract the outstanding or unpresented checks, those things which have reduced the balance, and we add the unrecorded deposits, or those things which would have increased the balance. When we start with our bank statement balance, subtract our outstanding or unpresented checks, add our unrecorded deposits, we are supposed to arrive at the balance as per cash book, thereby reconciling the bank statement balance with the cash book balance. In part 3 of this series, we are going to look at a worked example.